Have you ever wondered what the secrets to successful investing are? Well, the answers may lie in the words of one man, Benjamin Graham. A titan in the world of finance, Graham was not just an investor, but an economist and professor, whose insights and advice continue to shape the investment strategies of individuals and institutions alike. His seminal work, The Stock Market, is more than just a book. It's an investment Bible that distills the complexities of the market into digestible, actionable insights. Graham's philosophy was straightforward. Investing is not a game of luck but a discipline that requires knowledge, research, and a keen understanding of market dynamics. This book has stood the test of time, continuing to guide investors decades after its publication. Its enduring relevance is a testament to Graham's deep understanding of the stock market and his knack for making complex concepts accessible to everyone. Let's dive into the 7 takeaways from Benjamin Graham's The Stock Market. The first takeaway from Graham's book is the distinction between investing and speculating. Now, this may seem like splitting hairs, but believe me, understanding this difference is vital to your journey in the stock market. Investing and speculating, while both methods of putting your money to work in the hopes of seeing a return, are fundamentally different in their approach, and more often than not, in their outcome. Let's start with investing. An investor, according to Graham, is someone who carefully analyzes a business, understands its value, and determines if the current price is below that value. The investor is not swayed by market fluctuations and focuses on the long-term potential of the company. They look for a margin of safety, a buffer between the price they pay for the stock and its intrinsic value. Thus, investing is about patience, research, and discipline. On the other hand, speculating is a different beast altogether. Speculators are more akin to gamblers. They bet on the price of a stock going up or down, often in a very short time frame. They are not particularly concerned with the intrinsic value of the company or the fundamentals of the business. Instead, they are swayed by market sentiments and trends, looking for quick, short-term gains. Now, it's important to note that Graham doesn't necessarily condemn speculating. He acknowledges that it can be a legitimate, albeit risky, approach to making money in the stock market. But he stresses that it should never be confused with investing. To put it in simpler terms, think of it like this. Investing is like owning a farm because you understand and believe in the value of the land and its produce. Speculating, on the other hand, is like betting on how much rain will fall on the farm in the next week. Remember, investing is about long-term growth, while speculating is about short-term gains. And in the grand scheme of things, it's the long-term growth that builds fortunes. The second takeaway from Graham's book is the importance of doing your own research. Now, what does that mean? It's not just about reading financial news or following trends. It's about digging deep into a company's fundamentals, understanding its business model, its competitive landscape, and its growth prospects. It's about scrutinizing its financial health, from revenue trends to profit margins, from debt levels to cash flows. Remember, when you're investing, you're not buying a piece of paper or a ticker symbol. You're buying a share of a real business, with real operations and real challenges. And just like you wouldn't buy a house without inspecting it first, you shouldn't buy a stock without researching it thoroughly. Don't just take someone else's word for it. After all, it's your hard-earned money at stake. Listen to the experts, but make your own judgment. Be informed, be curious, be diligent. To invest wisely, you need to do your homework. The third takeaway from Graham's book is the concept of the margin of safety. Picture this. You're crossing a rickety bridge. Would you feel safer if the bridge could hold just your weight or double your weight? The extra capacity is your margin of safety. In investment terms, it's the difference between the intrinsic value of a stock and its market price. It's like buying $1 for 70 cents. This concept is crucial because it gives you a cushion against errors in your analysis, market volatility, and unforeseen events. When the market price is significantly below the estimated intrinsic value, that's when the margin of safety comes into play. The larger the margin, the greater the potential for profit, and the lower the risk of loss. This concept is not about guaranteed profits but rather about reducing the risk of loss. It's a strategy of managing risk, not avoiding it. The margin of safety can be your safety net in the volatile world of investing. The fourth takeaway from Graham's book is the importance of diversification. Diversification, in essence, is the act of spreading your investments across a variety of assets to minimize potential risk. Imagine you're at a buffet. You wouldn't load up your plate with just one kind of food, right? You'd want a bit of everything to ensure a balanced diet. The same principle applies to your investment portfolio. By investing in a range of different sectors, industries, and companies, you can mitigate the inherent risks associated with putting all your eggs in one basket. If one stock performs poorly, the others may help offset the loss. But remember, diversification isn't just about quantity, it's about quality too. It's not enough to own a multitude of stocks. You need a well-balanced mix of growth stocks, value stocks, international stocks, and more. So, diversification is like your financial safety net, ensuring that even if one trapeze artist falters, the show can go on. Diversification is not just about owning different stocks, but different kinds of stocks. The fifth takeaway from Graham's book is the role of emotion in investing. Emotion, although a fundamental part of the human experience, can be a double-edged sword when it comes to investing. On one hand, it can push us to take risks, to invest in opportunities that may yield great rewards. On the other hand, it can lead us to make impulsive decisions, often driven by fear or greed, that can have detrimental effects on our investments. One of the most common emotional mistakes investors make is panic selling, which is selling off assets out of fear during a market downturn. This is often a knee-jerk reaction to short-term market volatility and can result in significant losses. Another common mistake is chasing performance or buying assets that have recently performed well out of greed, often leading to buying high and selling low. Awareness of these emotional pitfalls is the first step to avoiding them. Successful investing requires controlling your emotions, not letting your emotions control you. The sixth takeaway from Graham's book is the importance of a disciplined approach to investing. It's easy to be swayed by the latest trends or to make impulsive decisions based on short-term market fluctuations. But Graham emphasizes that discipline is essential for long-term investing success. A disciplined approach means having a clear strategy and sticking to it, even when the market is volatile. It involves setting investment goals, diversifying your portfolio, and regularly reviewing and adjusting your investments as needed. It's about making informed, deliberate decisions rather than being swayed by emotions or the latest market gossip. This disciplined approach also means being patient and not expecting immediate returns. Investing is a long-term game, and it takes time to see the fruits of your labor. So, don't be discouraged if you don't see immediate results. Stick to your plan, be patient, and remember that discipline is crucial for long-term success. Discipline is the key to investing success. The seventh and final takeaway from Graham's book is the value of patience in investing. Picture yourself as a farmer, planting seeds in the soil. You water them, nurture them, but you don't expect them to grow into tall trees overnight, do you? Investing works on the same principle. You plant your monetary seeds in the fertile ground of the stock market and wait for them to grow. Patience is not about sitting idle. It's about understanding that good things take time. It's about making informed decisions and then giving your investments the time to mature. It's about resisting the urge for immediate gratification and focusing on the long-term gains. So, when you find yourself anxious about the ups and downs of the market, remember that time is an investor's best friend. Market fluctuations are part of the journey, and it's patience that helps you stay the course. Remember, Rome wasn't built in a day, and neither is a successful investment portfolio. So, these were the 7 takeaways from The Stock Market by Benjamin Graham. We started with the fundamental difference between investing and speculating, underscoring the importance of making informed decisions based on careful analysis, rather than taking shots in the dark. We then moved on to the significance of research, showing how it forms the bedrock of any successful investment strategy. This was followed by the concept of the margin of safety, a principle that emphasizes the necessity of minimizing risk. Next, we delved into the world of diversification and its role in spreading risk across various investments. We also explored the role of emotions in investing, highlighting the need for a disciplined, objective approach. The penultimate takeaway was the importance of discipline in investment decisions, and finally, we talked about the value of patience in the world of investing. By understanding and applying these principles, anyone can become a more successful and informed investor.